market now. All right. So let's look at this candle, right? This candle, somebody tell me what this wick, the purpose of this wick is. Is it to establish the low for the swing low? Or is it hunting for something?
I said probably hunted for something.
That's right. So this body is part of the swing low, right? So low, high, low. But this wick is hunting for liquidity on the left side of the chart. Let's find it. And that liquidity lies right here. Okay. So what is this? So we break this down on a lower chart, right? This happened on 18 January, so lower charts won't. Let's see if the 5-minute will let me. And is this 8? Nope, this is February. 18 January. All right, right here. All right. I think I'm going to get the 5-minute, right? It's probably going to be the lowest it lets me go back.
They got their money back.
Exactly. Right? They got their money back because we know this gap has already been filled and that they weren't targeting this order block because this order block is one red candle. What were they doing here?
Manipulation.
Yes, but check this out. So we have these lows that never had a return that they were taking out.
So stop hunt for those lows.
Not a stop hunt. You messed that up, bud. But I'll explain why. What is this? So all right.
Is that retracement?
So they got their money back from this manipulation movement, right? Who said that? Matt Oliver?
Yeah.
Okay. So check it out. They manipulated the market up, right? Up, and then they retraced, up, they retraced, consolidation, manipulation, and then distribution, which is a new phrase I need to teach you guys, but not tonight. So basically they were just getting their manipulation money back at a lower price. So this manipulation for this retracement at a lower time frame. So if I put this on the 1-minute time frame or the 30-second time frame, this is a bearish market because we had a bearish break of structure. If we look on the lower time frame, expose more candles, this is a bearish market. Even though it was from 615 to 750, guess what? Trillions of dollars in the stock market. Something that happens from 615 to 750, like that holds a lot of money because what else is this? This is a consolidation zone, right? So what happens? What do we know about consolidation zones? What's happening within that consolidation zone?
They're trying to collect orders so they can shoot up.
Yep, exactly. So basically on 18 January, that wick that happened a couple of days ago, they were coming back for this, right? And so that's, we'll get to the part of that in the next phase of this course because I don't want to get you guys too sidetracked. I just wanted to show you guys that everything has a reason. Let's go back to where we were, which we were talking about swings and breaking market structure. So does everybody understand the purpose of swing highs and swing lows? So I revealed something new today for all of you guys, right? You guys knew what swing highs and swing lows were, but somebody explain to me that knows what a swing high and low is. What's the purpose of it? So the purpose of it is that retracement, that area. Okay, this doesn't look familiar, but it is. I just need to adjust the charts back to reality. All right, here we go. All right, so we have this swing high. The swing. Okay, so we have this bearish drop, right? So we drop. And if we break this candle down into a lower time, we'll have the same concept. We'll have a bunch of swing lows happening, right? And so remember, When we retrace on a downward movement to the upside, what's happening? The central banks are just getting more orders at a better price to the downside, right? And they're getting more orders because when they shot this price down right here, they ran out of gas, right? So they have to get more short orders at a better price than when they ran out of gas. They're just going to shoot the market up, and the difference between this body and this wick when they were getting orders is like profit for them, right? So that's the whole purpose of swing highs and swing lows is the central banks are just picking up orders at a better price to the direction they're going. If you see market structure, which if I had 2 or 3 green candles, like right around here, before this swing high happens, like what do you think they're buying? Are they buying short or are they buying long? So they're gonna be buying long orders. Like let's say there's 3 green candles here. These 3 are green candles to the upside, right? Which if we break it down in the time frame, it will be essentially 3 green candles, right? They're buying long orders for the next move up, right? All right. So everybody understands break a market structure, break a structure now, right? And a little bit more refined of swings, right?
Yep.
Who said no?
I said, yeah.
Okay. Is anybody confused? Franco, you good now?
I'm still a little confused, but I'm going to work with one of the guys offline.
Okay, cool. So now let's talk about fair value gaps. Who's confused about fair value gaps? All right, cool. So a fair value gap, remember, supply zone, demand zones, and fair value gaps all play together, right? All right. Because the fair value gap creates a supply or demand zone, right? And what a fair value says in a supply and demand zone says, what is supply and demand is just like supply needs demand and demand needs supply. So in this case, it's more sellers and buyers, and every seller has to have a buyer, and every buyer has to have a seller, right? All right. So all a fair value gap is an area where you have inefficient price, which means you have sellers that don't have buyers, right? So there's 2 types of gaps. There's liquidity voids and there's fair value gaps. A fair value gap is 3 candles, and you're going to see fair value gaps more than you see liquidity voids unless you see huge movements, breakouts like this. All right. So this is a fair value gap, George. So right here you have 1 candle, seller. And then it sells off and then it comes back, right? Now when you see wicks, so like, all right, let me explain this to George and then I'll explain the next part to you guys that know. All right, so 3 candles. 1, 2, 3. The area where this candle stops, whether it's the wick or the body, and meets up with the 3rd candle is a fair value gap, right? We have sellers, but those sellers need buyers. Does that make sense, George? Oh, okay. I can teach you.
Yes,
I'm going to go
it
into that
makes
right
sense.
now. All right. So now we have liquidity voids, right? So these are all fair value gaps, right? And here's why. All right.
All those green
Because
candles, all those green candles to the bottom right there, why you're at, those are fair value gaps also.
these are all fair value gaps because I'm about to teach you right now, right? So when you see wicks, right? This looks like a liquidity void to the eye of somebody who doesn't know, right? So these are fair value gaps because you look at the wicks. This at some point came up with buyers and then sold with sellers, and then came up with buyers and sold with sellers, came up with buyers and sold with sellers. So the fair value gaps are just like this, guys. Fair value gap because everything between this point and this point, let me box it off for you guys. There's a separation within the price inefficiency. It's fucking TBI, I swear. And then just me trying to use big words, right? So look at this, guys. Huh? All right. So look, fair value gap. 1, 2, 3. 1, 2, 3. 1, 2, 3. All right. So you see where the wicks, where I don't have marked off, you have buyers that came back down that are sellers, right?
Yeah.
And then the candle jumped over and it sold off a little bit, and then buyers, and then sellers, and it closed. It came over here, buyer, sellers, and then buyers, right? So these are the fair value gaps. People misunderstand these as liquidity voids, right? But they're not. The green areas that I've marked off are fair value gaps, right? So a liquidity void is when you see candles like this.
Hi, Mickey.
And if we, yo, hey,
What's up,
bud.
everybody?
Hey.
It's just like that. You see how there's just bodies. There's more than one body that doesn't have a wick to the upside in this example. So you don't have any sellers at the top of this. It just closes with the body, opens up, no sellers happen, and come up. So let me show you a quick example of a liquidity void that happened on Friday.
Some good stuff,
And you
Mick.
usually will find, thanks, bud. You'll usually find these liquidity voids. They're very rare, and when they are there, they're very, very much targeted, right? So even on Friday, when we had that big shoot up to the upside, like we still have fair value gaps, right? Because they're smart about it. But like, look at this candle right here. You see how there's no wick? If you have multiple candles, no matter what the time frame, that look like this with no wicks, I mean, the second candle can have a wick coming down, but it can't have a wick coming back up. They're very hard to find. So like, when you do find them, like, that's your gold nugget of like, you damn well know, like, that's the next hot shit, right? All right. Does everybody understand the difference between liquidity voids and fair value gaps?
Yes.
Okay.
Yes.
So here's my new
No.
sprinkle of knowledge with fair value gaps, right? All right. We're going to take our Fibonacci retracement, right? And we're going to make it like this, right? We're going to go into settings. We're going to only mark out the 0, the 1, and the 0.5, and we'll make them different colors, right? Whatever colors you choose, I don't give a shit, right? All right. So now it doesn't matter the time frame. It doesn't matter. This is the story behind it, right? All right. What do we notice?
Goes up to the 50% and then gets rejected.
Right? But we also know that there's order blocks up here, right? So we know we have an order block, which I'll mark right here. We got 2 green candles before the downward sell, right? All right. So, and you guys will see this, and you will, like, you learn this stuff by observing only the 1 minute chart, right? All right. So look at this. Almost every fair value gap, Matt Oliver. I want you to hear this. Are you on? Sean, are you on?
I'm here, buddy.
Yeah,
All right.
I'm on. I've been having trouble watching you, but I just finally got on my phone and I can hear now.
Okay, perfect. What have you missed? Like, what did you just pick it back up at?
About the last 5 minutes.
Oh, okay, cool. That's all I need you to pay attention to, right? So almost every fair value gap, whether it's the minute or the hour or the daily or whatever, right? Well, you'll always be able to. So if this fair value gap happens, and just by luck, like this happened on the same time frame, right? We mark off the fair value gap with our Fibonacci retracement, and what will always happen, right? Especially on certain pairs and certain stocks, like it will come back up, and it will come to the 50% mark of that gap, or right below it. And if we're going down to the upside, it would come down to the 50% or to the 40% and below, and then it would sell off, right? Because they understand that there's smart money traders out there, smart money concept traders out there, and they know what order blocks are. Like, they're not stupid, all right? So they always come up, and they know that now we're searching for the banks of America and the smart money concept traders that are on Wall Street, right? Oh, they're coming back to this order block. Let's go in and buy in because, like, let's buy our shorts at a discounted price. They know that as this comes up, they know it's such the traders that they're hunting for at this point aren't the dumb ones. They're hunting for the smart ones. They know that the smart ones know that this order block exists. So so as they come up, they know this are trying to buy on the way up because they know once it hits that order block, they can have a quick rejection down, right? All right, so they're buying, and then you have the traders that buy opposite regardless. If the market's going up, they're buying shorts because they know that the way it's going, the central banks are doing the same thing, right? So usually when you see the fair value gap, you're going to see this. And if you don't see it on the time frame that you identified the fair value gap, then just continue to refine this gap down, down, down. I usually refine my fair value gaps all the way to the 1 minute, right? I refine my order blocks to around the 5 minute, like no lower than the 5 minute. And then, like, when I actually go for my entry, that's when I go into my order block and I find my entry on the 1 to 3 minute off of the same stuff that I've been teaching you guys, right? So did you guys know that part? Let's see if old Mickey's full of shit, right? All right.
You're not full of shit,
There's
Mickey.
another fair value gap. All right. Ah, fucker.
That's money to be
And so
made
when you
right
mark-
there.
So that's your fair value gap right there, right?
This is my fair value gap, right? And
Yep.
you can't measure it off of this, right? You can't measure it off of this. You have to use the 3 candles, which is why I tell you fucking 3 candles, right? Candle 1, candle 2, candle 3. So at the top of the wick is where I start. I draw up to this 3rd candle. And look, I said between the 40 and the 50, bam, and then it pulls up, right? And then it's going to return to that order block right here and then continue to shoot back up. All right. So now, so far we've confirmed that everybody knows higher highs, higher lows, swing highs, swing lows, and when they're utilized, and how we can pick up trends, reversals off of that, right? We've talked about fair value gaps and the difference between a fair value gap and a liquidity void. And the last thing I want to talk about before we move to the strategy and start really breaking down the high probability strategy that I want you guys this week to focus on. Oh, let's go with supply and demand. All right. And then order blocks, right?
Mm.
All right. So there's a lot of confusion about supply and demand. Can somebody explain the difference between supply and demand and fair value? Demand and order blocks from their what they think.
Well, I think what order block is so if we're going into a bullish market, it's the last red candle before an upward break of market structure, and that's your order block. And then reverse for the bearish, it's the last green candle before a break of market structure heading to the downside.
Exactly. And what's happening within that green or red candle, the last trend candle? Think about everything has a story. Remember, like I told you, I'm like, every wick, every body has a story. And once you learn the story, you're going to be able to know what's going on next. What do you think's happening? What do you think the central banks? So this is the last green candle before the downward move. What do you think the central banks are doing in this candle?
It's where the
think
banks
they're buying
it's where the banks are coming in.
They're buying
do you think?
shorts.
They're
Yeah.
buying short,
Yes.
right?
Yeah.
So that's
Yeah.
the reason it's called an order block. All right. So let's take this for example. So order blocks, right, can be anywhere in any movement where we have structure. This is consolidation, so I stay away from order blocks in the consolidation zones, and I try to pick them up, right? But let's talk about the difference between supply zones and order blocks, right? So a lot of y'all are getting confused on the two and where to market, right? So this is a supply zone. This candle right here is a supply zone. Why?
Because the market before that there was created on that green candle, so that was a created market. So now they're retracing that previous move up.
Cause of all those buy orders right there, they need
Yeah.
to unload.
Yep.
Nope. Keep going. Keep guessing.
Wait, what was the question?
Why is this a supply zone? This candle right here, this red candle, why is this a supply zone?
So, does it have something to do with the fact that there's significantly more volume going on there, and that so you can see how it moves in the green candle? There's not a lot of volume.
It
but
has
still
nothing to
moves quite
do.
a bit.
Okay, so check it out. Order blocks have to do with this green candle. Supply zones, and order blocks everywhere on the breakouts up and the breakout down. Because the order block, all it is the central banks ordering
Okay.
because they ran out of gas on that movement, or they're
Right.
loading up for the next trip. Okay, think of it like this. Think of it like this. So right now, the central banks are going to go on a vacation down here, right? The last thing you do before you go on vacation, or the first thing you do when you're prepping to go on a vacation, is you do what? You fill up your gas tank, right? This is them filling up their gas tank. They've been here consolidating and working. And now the manipulation, the whole purpose of the manipulation is for the central banks to fill up their gas tank to go on this vacation, or they're on vacation, right? So look, they're on vacation. They filled up their gas tank on this red candle right here, right? That's the order block. They go on their trip, and then they run out of gas, or they become low on gas, right? They need to fill up their gas tank at a better price right here to continue going to the trip, right? A supply zone, right? Does that make sense with an order block? So you have order blocks in supply zones, but you have them on the trip too, because all they're doing is filling up their gas tank for the next leg of the trip. Supply zones and demand zones, what does every buyer have to have?
Seller.
And what does every seller have to have?
A buyer.
A buyer. There's
Right.
gaps.
So they're
There's-
giving supply to the market, so that way it has the opportunity to go back up.
They're creating a market. Yes.
They're creating a market, yes. So this is a supply zone, and this is the order block, right? All right. So order block, supply zone. Order block, they're about to go on a trip to the downside. They're filling up their gas tank. However, the downside, they speed all the way there. And now, like, we need buyers, right? So the supply zones only happen at the bottoms of fair value gaps, right?
And
Because remember,
Yep.
we need buyers for these sellers, right? And in between, as we break it down, there's going to be little gas strips, order blocks there in between, right?
Hey, Mickey.
Yo,
So for that supply zone, would it be a little bit lower to the top of that red wick?
okay, so how do we mark the difference between marking supply zones and order blocks, right? All right, so in this case, the supply zone trumps the order block, right? All right, so because the supply zone is at the beginning of the fair value gap and the order block's designed this way, so I'm going to mark the supply zone. So the supply zone starts at the fair value gap and goes to the last highest point of that swing. So if I break this down, this is a
Gotcha.
swing high, a swing low, right? We go from low
and
to
it's gonna
high.
and once it breaks 50% of that previous order block, that's when it dropped all the way down.
Say that again.
So when you look at that previous order block to your left, that large green candle there, once it breaks 50% retracement on that candle, on that big red bar down, once it broke all those support levels, that's when they flushed it. It was when it broke 50% retracement on that left side green candle. You can match it up with the large red candle there, and it's the large previous order block before he's right. Go back to your left and go down a little bit, Mickey. Back to your left. Yep, right there. That one. So as you match a 50% retracement on that green candle, that's when it dropped and gave all the weight down.
So he's talking about this candle right here. So the reason it filled this gap was right here.
Yep.
And honestly, like, this is an order block, and right now we don't see any retracement to the upside, right? But if we break this down, because
It's
1 hour
gaudy.
time frame, if we break this down, you will see, like, it came up, it came down, filled in this gap to try to convince the smart traders, hey, we're on the downside right now, but because they're filling this gap, they're heading into this order block. And they're also, the reason why this strategy is genius is because they're trapping both the buyers and the sellers, right? But if we break this candle down, if we digest this to lower time frames, when it hits this order block, it will do the same strategy
All
and
the
then
way
come
down
up,
and fill all that shit all
it'll
the way
come
down.
back up, and then it'll come back down, right? Which is why I'm teaching you that strategy. All right, so do you guys understand the difference between supply and demand zones before we move on?
Yes.
Okay.
High five.
Anybody confused? Huh?
I said, everybody, high five.
Yay. All right,
High
so
five.
Franco.
We gotta keep it light. High five.
High
Okay.
five.
Well, I'm still a little confused with the supply and demand zone, really.
Okay, so check it out.
Your supplier,
we have
the people that
myself.
want to buy and they want to go up, and then you have the demand on the way down. They're basically giving you, they're showing you the movement, like in layman's terms, because Mickey's super smart on technical, and maybe I can put a layman terms into it. Imagine that people are at an auction, and you see all these buyers are like, we're gonna buy this shit from $1 all the way to $10, and you're like, well, they were all wanting to buy it at $10. Well, the beginning people want to buy it at $1, so they create this block, this huge thing, and then a big order comes in where it just shoots it straight up, and that order is just basically showing you what the next move down is going to be. And if it breaks past that previous order, then you stay long. But once it gives you back a little retracement, like on where he was showing you how it never came and hit that tire wick on that last top out, so it didn't come and break that, so it didn't give us another order block. It said, hey, this was your move up, so now you see that candle is now going to be your next move down. If you look to your right now, there's a wick that bounces all the way to the bottom of that order block, right? And it gives the people another chance to go long. So you can use that. That's where they go, well, you're looking at previous data. Well, if you're looking right where his thumb is, right where that pointer is, well, if you're looking just at that data, you know you're willing to buy at the bottom of that green candle. So if you put an order in on a horizontal line all the way across, look what would have happened. You would have filled, and then it would have went all the way up to the top of that previous move that he was talking about. So it's kind of like
All right,
they filled that.
Let me take back control, bud.
Yeah, go
All
ahead.
right, so check this out. Only because like the first part of this lesson was designed to reinforce you guys and teach you a little bit more, but the second part of this lesson is going to be for the more advanced players in this room, right? But you guys all can sit in on it and start familiarizing it, right? So right now I need a mentor for Franco, for George. I'll take Hamza, and then I'll take Sosa as well. So can I get somebody to like help George and Franco out on supply and demand zones and swings?
Yeah, I got Franco.
Okay, and
Yeah.
Matt, you got George.
I've been working on George. With George. Hopefully, I can answer his questions.
Yeah.
Or,
All right.
or if Matt or Sean aren't available, I can jump in wherever you guys need. Just let me know.
Okay, perfect. All right, and Sosa, I got you. I'll come to your office next week and we'll sham out of work and I'll teach you this.
Thank you.
All right, bud. All right, so check this out, guys. Now we're gonna move on. Like that was just a quick recap of where you should be in the course, right? And if you're not, that's okay. The stuff I'm teaching you guys, I've already taught you guys this strategy, but now I have to define the rules to it, right? So remember what's happening here, right? Remember this pattern right here, guys?
Yeah.
All right, so we have a run on liquidity, right? So let's define this a little bit more. All right. So now let's define this. All right. And let's take that candle out. This to advance. All right. So we have high to low retracement. So we have swing highs, high to low to high to low to high to low to high, right? All right. So that's where the swing highs come into play because we're in a bullish market, right? And we know that these are break of structures, right? Because what makes them a break of structure?
Takes out the previous high or the previous low.
Right.
They're still
Exactly.
going in the same direction, same bullish direction.
It's confirmation that we are going higher, right? Because we established a swing high, but until we have a candle break it above this high, we could see a reversal, right? So we don't want to buy in too soon, right? All right. So now this is how we tell break of structures versus a reversal, right? So these are all bodies, right? We talked about bodies, right? We have a high and then a body up, right? Break of structures, not break of market structure, right? All right, but now something happens that throws me for a loop, right? All right, that gives me the clue because remember, it's all about clues and confirmation, right? All right, so we come up, and then instead of a body, right? Let me draw you guys a little candle here so it makes sense. Okay. This is my fucked up candle. Does everybody see
very
the candle
nice.
here? Very nice. All right, so all the way up here, the thing that engulfed the previous high was a body, right? But instead, this time, we have a wick. We have a shoot up, a liquidity run to take out the liquidity above this high. But then before that body closes, it comes back down below the high, right? And it leaves this wick, right?
Mm-hmm.
So now, does everybody understand that concept?
That's the stop hunt, right?
That's the stop hunt, right?
Absolutely.
So check this out. So now, and I'm just going to refresh this strategy, and then we're going to go into the different rules that we have to see in the stop hunt and the high probability rules, because that's going to happen, right? Now, after the stop hunt, what's the most important confirmation piece of this?
Break a market structure.
The break and market structure. The break and market structure, if you understand that alone, will make you money, right?
Yeah.
So the moment, so we can wick this all day long. We can wick below this and we can consolidate. So you'll see in the Asian range, we'll just do this, right? And we'll have a shit ton of break and market structures, but it'll be wicks, right? And those are little plays within themselves. Basically, the Asian range and from 14 to 2000. So from 14 to 2000 is something known as the central bank Dillon range, and from 1900 to 2300 is the Asian range, right? All this happening there is the reset and the refinement of the next day. What's going to happen? Every high that's going to happen the next day, every low that's going to happen, but that's more advanced. I won't talk to you about that. All right, and not yet. So right here, when this candle closes below here and we get that break in market structure, we know we have a play here. All right. We know that we're going to take that supply zone, right? I mean, that order block, right? Let's say the candle shot down, right? Two candles were formed on this movement right here, right? Let's say this is the candle and it shoots back down, right? Two options were formed right here. We have an order block, the last green candle, and then essentially, if it plays out, we'll have a red block, right? We'll have a red block and then a shoot down block, right? Establishing the fair value gap, giving these guys sellers, and that's the difference between supply zones and demand zones, right? So we're going to mark both of those. We're going to mark the red block and we're going to mark the green block, right? Because we need to identify which orders, where the order is going to come back. Is it going to just come back in the supply zone, or is it going to grape soda and a bag of chips? That's all we got. All right. If you're eating chips, fuck you. Stop it. You're messing my hearing aids up. All right. So when this play happens, right? When we have that break in market, it was going to mark off the supply zone and the order block, right? So in here, let's pretend like we have that movement down, this movement down, right? Right here is the order block for that movement. And let's say we have the red candle, the beginning of the supply zone, right? Right here, right? So this is the order block. This is the
So
supply zone. We had
the
one
red
red
candle would
candle.
be the supply zone.
Huh?
The red candle, if a red candle come there where you are right now, that would
Yep.
be the supply zone.
Yeah, because what's going to happen, right?
And that's your
Right.
order block. The green candle is the order block.
The green candle is my order block here. If this little box right here, which I'll change it to red, right?
Mm-hmm.
All right. If we establish, let me do this real quick. If we establish, right, we have one candle, the body is right here, right? And then
Yep.
we have another candle that shoots down, right? Because it will shoot down off of this play, right?
Yeah.
So let me make this smaller so you guys can see. All right. So let's say the next thing that happens is the next hour at 9, whenever the market back opens, we have a candle that just stays within this range and it closes, right? And then it shoots down, which it will every single time. I'll show you. This is my supply zone. This is my order block, right? So I'm going to mark them both. And that's what I was trying to explain to you, Matt, and you, Sean, right? I'm going to mark them both, right? Because now I know when it returns, is it just going to come to my order block? Or is it going to come to my supply zone?
It should come to your supply zone, right?
Why?
To take out the, guess what you said,
The
liquidity.
supply zone, right?
The supplies, yeah.
Now let's swap this, right? Let's make this one, if that break, let me erase some stuff. Let's say the candle plays out like this, right? We have this next red candle being this size, the box is this size, and the shoot down candle is this size, right? Now I'm going to highlight them both. But now, right, what do I see? Let me mark this blue so it doesn't confuse you guys.
Your order block is higher up.
Yes. Now, what does that mean?
Oof. You're the boss, man. You tell us.
All
It's
right.
gonna
let me
go.
tell you.
It's gonna go up higher, right?
It's going to go up higher. So I'm going to look for my entry. And if I have to babysit the market, right? If I can't babysit my market, right? My limit order is going to be right here compared to right here, right? And my stop loss is going to be like 5 points pips up here, right? But I know it's guaranteed to come up here before it does the next phase of this, right? Which is selling off, right?
Mm-hmm.
Before it's selling. So when it returns back, when we do our RTO, right? I know a couple of things. I know it's going to retrace on one of the time frames at the 50% mark of this gap. So it's going to come back up. It's going to get to the 50% mark of this gap. It's going to retrace back. It's going to come up to the supply zone. And guess what it's going to do most of the time? It's going to sell off because it's trying to trap the smart money buyers that are going stop hunt, break a market structure, return to order block. So they see the supply zone. So their limit orders are right here, right? And they're just going to like sell it back off. And then they're going to shoot it back up and they're going to stop them out, right? The supply zone people right here, they're going to. So I'll always go for the higher zone, right? Whether it's the order block or the supply zone, always go for the higher one, right? And I wait for it and I don't chase it, right? I don't chase it. That's the most important part. Like, so when it comes back to the supply zone and it shoots off, I'm not getting in short yet. I'm going to wait. It might take, if this is our chart and this is happening, yo. Nice. I'm on speaker. Get out of here. All right. Hey, so that's the purpose of it.
Hi.
My wife's a tard. All right. She does that. She does that just to embarrass me. She thinks it embarrasses me, but it doesn't. All right. So that's the purpose of it, right? So I'm going to wait until we get in this order block. And guess what? This is the best part. This is the part I want you to pay attention. Let's talk sniper entries, right? So let me erase all of this. All right. So check this out. Once we get back to this block, right? We're going to look for that same pattern. All right. So we're going to jump to the 1 minute and 3 minute. That's what I was talking about. All right. So when we get up back into this zone and the candles are up in here, right? This order block, I'm jumping to the 1 minute chart, right? And to know my confirmation, right? To get the best entry possible, guess what it's going to do on the 1 minute chart? It's going to do this on the 1 minute chart within that order block or within the supply zone, whichever one was higher in this case. What is this? Stop hunt.
Break a market structure.
Break a market structure. It's going to sell out. Then it's going to return on the 1 minute chart in this area. And that's going to be my cue because there's this point of interest. It will always establish that point of interest on the chart and it will sell off. So guess what my entry is? Right here.